inflation cooled in July, but prices are still rising.
Yield curve control, maybe? Question of yield curve control, but whether it's with yield curve control or...
Canada has always lived in the shadow of global markets. From oil prices to trade deals, from Washington politics to Beijing tariffs, every Canadian household feels the ripple effects. You may not follow bond yields or central bank decisions or trade negotiations in real time, but you feel them at the grocery store, in your mortgage renewal letter, in the cold sweat that comes when another bill is due. And right now, that invisible system is shaking. In July, Canada's headline inflation cooled down to 1.7%, largely thanks to falling gas prices. The news sounded like relief, a breath of hope. But the reality behind the number was harsher. Groceries were still rising 3.4%. Shelter costs had reversed their decline with a 3% increase, and consumers still felt the squeeze of a system that refuses to give them a break. Economist Benjamin Tal, deputy chief economist at CIBC, summed it up bluntly. We are in a per capita recession. Inflation is close enough to 2%. It's time to cut. They should have cut before, but I think February is now very reasonable. And yet, even a rate cut, as Tal warned, wouldn't be enough. Because what Canada faces isn't just about interest rates. It's about the uncertainty related to Trump, he said. Tariffs have become a weapon. The Canadian Federation of Independent Business warned that small firms are on the edge of collapse. 1 in 5 businesses facing new tariffs said they might not last 6 months if nothing changes. Steel, aluminum, lumber, dairy, autos industries built over generations are now caught in the crossfire of a trade war they didn't start. Ontario Finance Minister Peter Bethlenfalvy described the battlefield. The steel industry, the aluminum industry, 50% tariffs. The auto sector, 25%. For companies hit square on, it's been a challenge. That's why we've put another $1 billion into a fund to support businesses. But even as Canada defends its industries, there's an uncomfortable truth. Across the border, the US isn't fighting for jobs or fairness. As Tal put it, when people say it's not about the money, it's always about the money. Tariffs are about raising money. A 10 to 15% tariff globally gives them $320 billion to spend. And that's where the story shifts, because Canada's fate is tied to decisions made not in Ottawa, but in Washington. On US Bloomberg, hosts debated a phrase that should send chills through every Canadian homeowner: yield curve control. What sounds like financial jargon is, in fact, a potential turning point. Yield curve control means the US Federal Reserve would print unlimited money to force long-term rates down, not just influencing markets, but overwhelming them. Bloomberg's Jonathan Farrow warned, the White House wants lower rates at the short end. But lower short rates could mean higher long-term rates, exactly the opposite of what they want for mortgages. If that happens, the US housing market shakes. And because Canadian mortgage rates move in near lockstep with US Treasury yields, Canada shakes with it. To understand why, Bloomberg broke it down simply. Bond prices and yields move inversely. If inflation expectations rise, investors demand higher yields to lend money. And no matter what the Fed does with short-term rates, longer-term rates belong to investors. That's why, even after the Fed cut by 100 basis points since September, the yield on the US 10-year Treasury rose by 60 basis points. Fixed mortgage rates, instead of falling, climbed higher. And that's where yield curve control enters. Unlike quantitative easing, where central banks buy a set amount of bonds each month, yield curve control is a blank check. If the Fed wants the 10-year yield at 2%, it will print however many dollars it takes, buy however many bonds it needs until the market bends. Bloomberg described it bluntly. They'll print as much money as they need to buy as many bonds as it takes. For Canadians, the implications are staggering. In 2021, quantitative easing pushed the average 5-year fixed mortgage rate down to 2.12%. If yield curve control happens, we could see downward pressure again on Canadian fixed mortgages, even as inflation remains sticky, even as Ottawa struggles with spending cuts. But here's the paradox. While Washington debates printing trillions, Ottawa debates cutting billions. The federal government has announced $13 billion in spending cuts by 2029, a 10% reduction next year, 15% the year after. That means up to 57,000 public service jobs could disappear in 4 years. Economist John Lester, a fellow at the C.D. Howe Institute, warned against across-the-board cuts. If it were up to me, I'd take a broader approach. Not exempt so much spending. Select programs after careful review. Otherwise, you're trading efficiency for speed. Yet Ottawa insists on speed. Cuts now, analysis later. Austerity on one hand, stimulus for defense and industrial subsidies on the other. And amid it all, Canada still exports mostly unprocessed resources: oil, lumber, critical minerals. Economist Jim Stanford from the Center for Future Work put it plainly: we dig it out of the ground and sell it, then buy back expensive products made elsewhere. If we want sovereignty, we need to do more of that work ourselves. That's where the value add is. Back in the housing market, reality bites. Mortgage broker Ron Butler didn't sugarcoat it. We have an incredibly slow real estate sales environment. New construction in Ontario and British Columbia has cratered, lowest in decades. Homeowners with renewals coming up, they're disappointed. Fixed rates aren't falling. Variable rates aren't falling. There's disappointment everywhere. Even as the Bank of Canada held at 2.75%, Butler said the pause meant nothing. It was totally expected. No effect on the market. People were hoping for relief. They didn't get it. The result? Canadians cut back on spending, construction halts, confidence erodes, and a per capita recession tightens its grip. So where does this leave us? In a fragile balance between tariffs and trade wars abroad and spending cuts and mortgage pain at home, between a U.S. administration that might print trillions and a Canadian government cutting billions, between economists urging prudence and households desperate for relief. Benjamin Tal warned, "This is not the end, this is just the beginning." And that is the real story. Inflation may cool, but prices still rise. The Bank of Canada may hold, but mortgages still crush. Washington may print, but Canadians still bleed. Every family in this country is caught in the same paradox, living in an economy we do not fully control, where decisions made in boardrooms and war rooms far beyond our borders decide what happens in our kitchens, our homes, and our futures. This is the insane true story of Canada's economy, shaped not only by inflation, not only by interest rates, but by the unstoppable collision of politics, trade, and power. And it's still being written.